A warm welcome to the Risk Reversal podcast, a special one because we're doing it in the aftermath, you like that word, of a jobs report. Guy Adami, Elizabeth Thomas here with you shortly after the opening of equity markets here in the United States. Here's what I gleaned, Elizabeth, and I'm curious
Mm.
as to your thoughts. Obviously, this is a situation where bad news in the form of a disappointing job number appears to be good news because the market is saying, you know what, we're going to get at least, well, I shouldn't say at least, we're probably going to get 3 rate cuts before the end of the year. I think we have obviously the meeting in September, which has become a foregone conclusion. Again in October, I think they skip November and then they
That's
go
right.
to December. And it appears as though some 75 basis points worth of cuts are somehow now baked into the cake. Your thoughts?
So by the time everybody hears this, which I believe is Monday, I'm sure the numbers will have been widely circulated, but we'll just run through them quickly here, the stuff that might not hit the headline. So jobs added for August came in at 22,000 versus expectations of 75,000. So that's a pretty big miss to the downside. Still a positive number. However, the revisions, so every time that there's a jobs report that's released, they have the opportunity to revise the prior 2 months and say, oh, we got better data, so on and so forth. We know that last month that happened and brought things down by a lot, 258,000 in revisions. This time, revisions were only 21,000, but it brought that June jobs added number down to a contraction. So right now, as of this last revision, the June jobs added was actually negative 13,000. And that is the first negative print that we have since 2020.
Right.
Now, July is positive, August is positive. So I'm not saying, oh gosh, everything turned negative. Now it's a problem. But it does change the narrative a bit from what we thought June looked like before. So that's where we're at today. Going into this print, the market's expectations for a rate cut in September were like 98%. So that wasn't really up for grabs. It wasn't necessarily a live meeting according to the market, which is what we call it when it might be more of a 50-50 split. It was already pretty baked in. We were getting 25 bips in September, not surprisingly. And actually, Guy, we talked about this yesterday on Market Call. I think Dan asked us, what does the number have to be to bring 50 back in? And I said below 35. You said, I think she's right, probably below 50. And look at where we are right now. It came in at 22, so below both of our watermarks. And we've got 50 back on the table with about a 13 or 14% probability for September. I don't think 50 happens. I think we would need much more bad news in order for 50 to happen. I don't think we're going to get it. We just don't have the opportunity for it between now and then. And last year, when they cut by 50, the circumstances were different. Namely, there weren't tariff pressures that were threatening inflation higher. So, and yields were much lower or much further away from where the Fed funds rate than they are now. So I don't think we're going to get 50, but we're going to talk about it.
I'm with you. And, there is a lot of noise, and there's going to be a lot of noise, I think, going forward, at least until you probably get into early next year, is my thoughts. I mean, I'm not an economist, but it just sort of feels that way. And if you listen to people in the administration, Howard Lutnick was on earlier today being Friday on Squawk Box, talking about you really have to wait this time next year to get a full understanding of what the administration's policies have done and how strong the economy is. So it's pretty clear to me that they're sort of going to the mantra they're going to be is you got to give this time. We're going to work through this. You're not going to see the full effect, the full impact until 9 months to a year from now. And the market seems to be sort of buying into that, and maybe they're right to buy into that. I'm not casting any doubt whatsoever. I'm just pointing out that seems to be the course of action. So I think what they're going to say is, yeah, we're going to have some sloppy numbers, but that's the pain we have to sort of endure to get to the other side. Question is, at what point, as you just said, does the labor market become a problem? Because right now the equity market is saying, we want this weak labor market because it has clearly put the Fed in play and we want lower interest rates. Of course, the problem is in an economy that's driven by people having jobs and being employed and earning a living, if that starts to wane, and you've talked about it, I mean, you use the term escape velocity. I use that same term. I'm not saying we're there yet, but you start going through this and it appears as though we're on the precipice of that.
Yeah. So, at what point does the job market become a problem? A lot of times people want something to look at, something measurable to look at. This is completely my opinion. This is not a mathematical opinion, but I would say if we start to get negative prints, and not just a negative print that was revised to be negative, but an actual live negative print that stays negative, that's when things start to get much more uncomfortable and the market decides that bad news is bad news, because then we're losing jobs, we're not adding jobs. And if that's coupled with it, which it likely would be, coupled with a rise in the unemployment rate, I would say above 4.5%. Because once we start to get above some of those mental thresholds, now 4.5% isn't some magic number that suddenly that means recession, but 4.3, if you remember from last August, is what the surprise high rate was when we surprised to the upside on the unemployment rate and everybody freaked out. It surprised at 4.3. So this is actually the high watermark right now. It came in at 4.3 today. Once it starts to rise above this, that becomes uncharted territory for, I'm sorry, was it uncharted waters? Uncharted
I think
waters
it's
and
uncharted waters, but
uncharted
but you could have
territory.
uncharted territory as well. But here's the thing: we're in 2025. My instinct suggests, with all the technology, with all those things that Dan Nathan likes to play with, in terms of territories, things, physical land masses. I don't necessarily know that they're uncharted territories anymore. However, the vastness of the ocean suggests there's still some uncharted waters. So how's
Okay,
that?
let's go ahead. Above 4.3% unemployment is uncharted waters. And that's where I think people will start to perk up their eyes and ears and say, okay, now this is a different scenario. We're looking at a rate cutting cycle that's now reignited, an unemployment rate that is above where it's been this cycle, and we're a little nervous about that. And if we get some negative job prints, I think that becomes a problem. So, and Guy, I think we're on the same page about this. Today, I would say that maybe bad news is good news today because the market wanted a cut. The market's going to get its cut. I put a tweet out. Mario helped me with this one. And we finished it by saying ammo for cuts is secured. And that's what happened today. It's secured, right? So if there was any question about whether or not we were going to get a cut in September, the questions are gone. Now it's a matter of how quickly are they going to continue cutting, and are they going to be able to continue cutting because they can, or will the data start to show them that they have to cut because they're trying to now stimulate or save something?
All right, so let's talk about that because obviously, the Fed bashers, in terms of people saying you're going to be behind the curve, you're always late. They're going to point to this job numbers and they're going to do "I told you so" thing, which is fine. I mean, it's their right to do so. Of course, the problem is, and this is not a problem. I mean, this is just sort of the seats that they occupy. But they made it pretty clear at Jackson Hole that the employment picture was now overriding their concerns with inflation, which may again prove to be right. But the flip side of that coin is inflation really is not going away in a meaningful way. I mean, their target is still light years away in terms of where we should be, or by this point. They're up against it a little bit here. I mean, yes, they're going to cut rates without question, but the gold market is telling a story here. There are a lot of things that are telling a story that the other side of the equation, their other mandate, they haven't fully sort of quashed that or put that back in the bottle. So that's really what I think now the market's going to start to sort of look at now.
Yes, I agree. And I think when we look back on this period of time, we will say that September cut was about labor. We might even say an October cut is about labor because we're going to get another jobs report by then. Inflation is still too close to when tariffs actually went into effect to maybe show the whole picture. So we may not get confirmation that inflation is a problem. We may never get confirmation that inflation is a problem. There are people out there that will tell you that tariffs are actually deflationary. So it may not happen that way, but the Fed knows that we're not going to know that yet. We're not going to know that with September data. We're probably not going to know that with October data. The lag time of how long it takes for tariff pressures to get into the consumer price data, not the producer price data, but the consumer price data, is about 4 to 6 months. So if a lot of these tariffs didn't even go into effect until early August, we've got time before we'll know what that effect even looks like. Not to mention, we're not sure how tariffs are going to shake out as it is, right? They're in the court system right now. There's a lot still yet to be seen. As it stands, the tariff rate on average is about 18.5% versus earlier this year it was about 2%. So they went up either way, no matter which way you slice and dice it, no matter how thinly you slice the pastrami. Tariffs went up. So at some point they're going to come into the data.
May I ask you a question?
Sure.
Are you a fan of the pastrami?
I mean, look, I am probably one of the least picky eaters that
Like
anybody's
that.
ever met. I don't like sun-dried tomatoes. That's about it on my
That's an
list.
that's an
Mussels.
that's
Mussels
an
and sun-dried tomatoes, not my thing.
that's an oddity. I mean,
I
that's
know.
good to know going forward. No sun-dried tomatoes
No,
on your
thank you.
sandwiches. Okay, moving forward. By the way, every once in a while, there's nothing better than like a hot pastrami on rye with a little
Yeah.
mustard. No
Yeah.
seeds on my. I mean, some people like the seeds in their rye bread. I'm a non-seed person, but that's just sort of personal choice. I mean,
So,
for
so
some
you
reason,
can
it's
get,
outstanding.
I mean, obviously everybody knows what a Reuben is.
Sure.
There's also a sandwich called the Rachel, which is kind of
Really?
like, yeah, I guess it would be, it's called the Rachel because it's like the girl version of a Reuben. Same way that you get like a croque monsieur and a croque madame, and the croque madame has an egg. Anyway, a Rachel, instead of it being some sort of beef product in the
Uh-huh.
sandwich, it's turkey.
I see.
And there's some coleslaw on it. Same thing, Thousand Island dressing, rye bread. So roughly the same idea, but it's turkey instead of some sort of cured beef.
So you said Ruben. I immediately think of Ruben Kincaid, who you don't know, but I will move on. I'll go from Ruben though to the Russell. Nice segue
Oh,
by Guy. You see what I did there?
alliteration.
Because because in theory, I
Uh-huh.
would imagine these small cap stocks are going to probably like what they're hearing. Now, I don't necessarily know if they should. I mean, that's a different, but they do now. So,
Mhm.
is this going to give? Because you follow this extraordinarily closely. Does this give sort of the green light to those people? Again, the Russell has not been participating to the extent that the broader market has. You think this is
Mhm.
going to sort of give the green light to these small and mid cap stocks? Driven mostly by banks, by the way, to sort of
Yep.
get off the mat here.
I think it gives the green light for them to get off the mat. Yes. Do I think that this is a long-term move that small caps are going to suddenly start participating and outperform large caps for the duration of this cycle? No, I do not think that. Well, I shouldn't say that. The duration of this cycle, if this cycle ends in a recession, that they may have some time to catch up, and then we've got an issue that happens later. A couple things I will say about this. I was at a dinner earlier this week and the subject of small caps came up, and the question posed to the group was something along the lines of, can you really say a bull market has finished its course if small caps haven't made a new high? And I thought it was an intelligent question, right? And it not necessarily a rhetorical question, but it was like, let's open that for discussion. And some of my pushback on it, or my question back to it was, well, small caps don't usually outperform at the end of a cycle, right? They outperform in the beginning of a cycle. So should we even be waiting for small caps to suddenly make a new high? And maybe it's not that they need to outperform large caps because over a long-term period, they're so far behind right now over the last few years that I don't think they're going to be able to outperform over the last, let's call it 1 to 3 years. But could they outperform between now and year end? Yes, I do think they could, especially if we continue on this rate cutting cycle, because that is some of not only the fuel for a rotation trade, which we've already seen the beginnings of, but it's fuel for the idea or the expectation that what if we get this right? What if these rate cuts are just adjustment cuts, in which case we do see growth down the road in the economy. And we do see a strengthening labor market later on. And we do see stable prices. That is healthy for small caps. We also would need some clarity on the policy front, and we would need some clarity on just the corporate America front in order for small caps to make those plans. So I do think that it opens the door for them to outperform between now and year end. The one thing I will caution people about is that, and we mention this a lot, I talk about it and I think about it a lot. If we're talking about the labor market right now and we have concerns about the labor market, do not forget that small cap companies make up about 2/3 of the US labor force. So if there is weakness in the labor market, chances are a lot of that weakness is coming from small companies. So you have to be careful about those little things that still pop up as well, but wait, this doesn't confirm what I'm thinking.
What surprises you most about like everything that's transpired over the last couple of years? If you remember, the Psalm rule was triggered. I don't know if it was a year or so ago. It doesn't even matter at this point. Claudia Psalm came out and said, "Well, it's not sort of etched in stone," so she sort of walked it back a little bit. Of course, I think if I'm doing it correctly, the Psalm rule, and bear with me a second because I want to make sure it's when the 3 month moving average of the unemployment rate rises by 50 basis points or so. So if the unemployment rate is 50 points higher, 50 basis points higher than the 3 month moving average, that triggers it. Now that happened again a while ago. We're probably not close now because the unemployment rate's been sort of hovering for a while, but now you could see 5, 6 months from now, if things start to accelerate, we're going to be having that conversation again. The point I'm making is like all these recession indicators that have gone off, that have been flashing red, have proven to not be trustworthy in terms of where we are now. Does that make any sense to you at all? Sort of just looking back.
Well, does it make sense to me? No. But it is the reality of what's happening.
Right.
So I think what we've had to do is step back and say, why is this different? And I am allergic to that, this time is different thing. But why are things happening differently than we would expect compared to history? And another thing that came out of this same dinner was, instead of thinking of it as don't fight the Fed, what if it's don't fight the Treasury? And in some of these scenarios where those rules haven't made sense, it has been a situation where, I mean, the Fed has been criticized a lot. I don't think necessarily rightfully so in much of this cycle. I happen to think that they've done a pretty good job, but they've been criticized and the credibility has been brought into question quite a few times. So, yes, of course, they still move the market. Yes, of course, it's important, but their independence has been brought into question. So, if their independence has been brought into question, that could mean that the government actually is the one holding the power. So, if we're looking at it from what's moving markets, what's saving markets or changing markets from actually sending those signals in the correct way, it could be that we've got fiscal strength and a government that is able to move it more than before.
All right. So the Treasury, you mentioned the Treasury, and they've been playing a very high stakes game of poker in terms of issuing short term bills, hoping maybe correctly that interest rates will come down so they can start doing longer duration issuances maybe sometime next year. And they're playing the game. And right now, it seems to be working to their benefit. I guess, and this started, by the way, with Janet Yellen. So this has been going on for a while. They just sort of push it out and we're just going to issue short term. But a lot of stuff is coming due. And at some point, almost by definition, they're going to have to start going farther out in terms of duration. Does that mean anything, or am I making too much out of that as well?
I don't think you're making too much out of it. There's right now, I think, especially in equity markets and a lot of ways the bond market, there's such a short-term mentality that people aren't looking at that as, how do we trade stocks today? And how do we trade the 2 year today? And even how do we trade anything in the belly of the curve, which would be under 10 years. So between, let's call it between 2 and 10 years. I think it is being reflected in the longer dated maturities, the consternation that investors are having to hold longer dated maturities, because at some point the bill comes due or things have to change, the policies have to change. But as we saw happen earlier this week, those longer dated maturities are also going to respond to economic data. So weak economic data could bring the yields of those down without solving the problem that you're talking about. So at some point, I do think it becomes an issue, or at some point, policy will have to change. Either of those things happening will require a repricing on the short end of the curve and in the equity market. I don't think we're there today. And I think there's still a mentality that they will figure it out before something like that should happen.
No, and that's it appears as though that's what the market is not only hoping for, but is betting on. So we'll see. So here's one for you. You obviously are on maternity leave. Your son is beautiful. You never really get away from what we do because you're always sort of watching it either very closely or bit from afar. So, you had an opportunity to sort of look at things from maybe 30,000 feet. You've been back in the seat now for a while. What should we be like? What are you looking at, like that you haven't been talking about, but it's sort of on your radar screen that, all right, this is something that we're going to start to do some work on because it's going to be a thing.
Um, some of the other sectors that could perk up here, and I think if we just think about it as a broad arching idea, being away for that much time does require you to slow down and come back to stuff and try to remind yourself of what you thought before. And being away and coming back and trying to remind myself of what I thought before, I did it in a way that I tried to find the data to prove what I thought before, and frankly, it isn't there, right? The risks that are still remaining and the things that should happen at certain points in the cycle just have not materialized, and we have to take that into account. So then I started to think about, okay, we constantly compare this to the early 2000s. Yes, we know that all ended painfully. Yes, we know that this is different from that in many ways. The thing that I keep coming back to is that even if we are tracking that, even if the behavior of this looks like that, we're not really close to the end yet. And this could keep going for a while. So we can either sit back and be grumpy and frustrated with the fact that it's not happening the way that we thought it might, or we can start participating in it and catch the rest of it, right? So what to watch, I think part of it is obviously valuations we're watching, but that's no surprise to anybody. I think it's what's the next sleeper, and there have been a couple sleepers in this cycle that nobody expected to be outperformers. Gold has been one of them, utilities was one of them. So now what's the next one? I happen to think it's healthcare. I think that there's also a possibility that it could be somewhere in the materials sector. And there are things to watch in those two places that are so far from the headlines, so far from the darling, so unloved and not sexy at all, right? And this has been a cycle for sexy stocks. Those are none of those things, but they could be another sleeper to watch as we go through the next 12 months or so.
All right, you brought up gold, so let's just sort of touch on it briefly. There's been no stopping it. There have been periods of time when it's been sideways to slightly lower, but gold has been rallying in environments where historically they've been challenged and they've been headwinds have been created. Gold miners have finally started to participate, but we'll avoid that for a second. Gold, what is the gold market? I think it's trying to tell the broader market something. I mean, there's clearly something going on here. I think central banks now own more gold than they do treasuries. I think for the first time in history, but history is a long time. But obviously, it's been for quite some period of time. Central banks, this has been my point. I'm not asking you to agree, but I think they've been hedging their own ineptitude or hedging against things they know are somewhat inevitable. Thoughts on just sort of what the gold market is saying?
Sure. So I think there are a few things going on here. Number one, something that we've talked about before was the weaponization of the dollar. And the idea, I think, broadly speaking, that many countries worry that fiat currencies are under threat, whether under threat by crypto or under threat, I think, more likely by policy. And by things that can happen in the macro and global political environment that actually prevents them from being able to use their own currency as they previously could. So gold has been the weapon of choice against that, and I think has been the savior to them against that. So rather than holding reserves in certain currencies that could be weaponized, or holding reserves in securities that are based in certain currencies that could be weaponized, they've chosen to hold gold. So that's been a lot of the demand that drove gold, I would say, up to its highs earlier this year. And we watched that rise happen pretty quietly, outperforming the S&P, but much of that rise, all of that demand was due to institutional ownership. Then retail came in. and gold became more of a trading asset. People started to perk up and say, wait a minute, you mean gold outperformed the S&P 500? How is that even possible? So gold now, I think, is in this place where, yes, it does look at crypto, what's going on in crypto. But I also think it's sending a message to the global economy. And because of the US, I mean, look at how much the dollar has fallen. It's sending a message to the global economy that we've got a fiscal issue and there are yields rising around the globe. We've got currency volatility around the globe. We don't know how a lot of that is going to shake out. And if our biggest concerns are long-term bond yields and inflation, currency is the thing that sees the volatility of that. So what's your other option besides currency? You look at gold to offset some of that vol.
Couple things. I was happy this morning, again, Friday morning, that you were not part of that 10 box on CNBC, because in no way, shape, or form should you be one of 10. You should have your own box. It should just be Elizabeth Thomas. I think you don't have to agree or disagree. You can nod in improvement, but I think you know that nobody puts Elizabeth in a corner, number one. Number two, my keen eye saw some sort of drink you are having. Could you enlighten the audience as to what you are consuming? Because it does not look particularly good.
I mean, it looks a little bit like beer. I'm not drinking beer on a Friday morning, anybody. I'm drinking kombucha. And Guy happens to be one of those people that thinks kombucha is gross. And I'll admit, it smells a little bit like feet, but it's very good for you. It's a live beverage. It's tea. Everybody knows what kombucha is. It's good for your gut. This is actually my second cup today. I didn't know that kombucha had caffeine until after I had started drinking
I
it a
see.
long
I
time
see.
ago.
So it's like
But
a probiotic type of thing. It's
that's
for
right.
gut health.
That's right.
And
Yes. So
and
I'm
just
hoping that it means I have a healthy gut.
I have no doubt that you
That's the
do.
idea.
Let me ask you this though. Um, Feet smell is not something that is typically um I don't know, you want to embrace or consume. Do you have to train yourself?
It can be an acquired
I
taste, but
see.
they've got a lot of flavored kombucha. This one I'm drinking is ginger flavored.
Uh-huh.
I'm a big ginger fan.
But flavored feet somehow is not really doing it for me. That's just me.
Flavored feet.
Well,
By the way, since we're on random personal anecdotes,
yes.
if anybody was watching Market Call yesterday, they found out that Guy was emceeing an event for the FDNY last night. And although he will not tell you this, I am led to believe that he absolutely crushed it. And they far exceeded their fundraising goal. So huge congrats to you for a successful event. I hope you enjoyed yourself. I am sure everybody enjoyed you behind the mic. And again, a huge honor. I hope that you are proud to have been the one to represent that. And I hope that you had a good time.
You're sweet for bringing that up. I appreciate that. It was a great event. I was a very small part of what was a tremendous evening. They raised, I think, over $4.5 million. They had a record turnout, 1,500 people on Randall's Island at their training facility. We beat the rain, which came at about 7:30, quarter to 8. And as far as I can tell, everybody had a great time. And in a world where everybody is polarized and in their foxholes, the FDNY, if you think about it, is something that everybody can sort of get their arms around. And last night was proof of that. So thank you for that, Elizabeth.
Of course. Of course.
You're the best. Elizabeth Thomas, she of SoFi. We won't put up that crazy, website because I can't do it right now. But Liz will be joining us next week, as she always does. Folks, thank you so much. A lot going on this Friday, and we have a lot to talk about next week. See you then.